Welcome to the SWIB Market Update. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB. Each quarter, we will talk with SWIB staff about the economy, the markets, and how the Wisconsin Retirement System trust funds are impacted. We'll also discuss how SWIB is working to help the WRS remain among the nation's most resilient pension funds, growing and protecting participants' benefits, and giving them peace of mind to focus on work, life, and the future. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave a review on Apple Podcasts so it's easier for other members to find this show. Joining us today is SWIB's head of multi-asset strategies, Nick Stanton. Nick, thanks for joining us.
Thanks for having me.
So Nick, the stock market has remained strong through the first 3 quarters of the year, despite economic headwinds from President Trump's tariff strategy, along with sticky inflation, a slowing job market, and global geopolitical conflicts. Why do you think the stock market has remained so strong?
Yeah, really good question. So as you said, the S&P 500 has returned about 15% through September, and it's a really good return. And as you mentioned, we have all these headwinds kind of coming at us. So a large part of this is due to the artificial intelligence boom. And because of that, I think it makes sense to talk about the performance of the top 8 companies in the S&P 500 versus the other 492. Currently, those top 8 companies represent about 37% of the S&P 500. That's higher than it's been in decades, and it's higher than it was during the tech and telecom bubble of the late 90s. So let's take a look at those 8 names. It's NVIDIA, Apple, Microsoft, Alphabet, which people know as Google, Amazon, Meta, which people know as Facebook, Broadcom, and Tesla. All 8 of those companies have significant exposure to AI. And AI has the potential to be a very transformative technology, as we all know. So if you're an investor right now, you're very much willing to look through things like tariffs, interest rates, and a slightly slower economy to get exposure to that technology. And when you look at the performance of those top 8 companies, they're up about 19% year to date, if you take a look at that index. Now, is that too much? Are people overpaying for those companies? Maybe, but it's really hard to tell. And as an example, let's look at the journey you went on if you put $10,000 into Amazon at the peak in 1999. Okay. So if you buy on the worst possible day in 1999 and you put $10,000 into Amazon, over the next 2 years, you lose over 94% of your money. That $10,000 of stock you bought is worth $560 in 2001. You don't get back to break even on that purchase for another 8 years. So in 2009, you make your money back. Over the next 16 years, from 2009 to 2025, the stock skyrockets, and now your $10,000 is worth about $412,000. So was Amazon a good investment in late 99? The answer could be yes, or it could be no. It just depends on your view on timing. Certainly the people that made the argument that Amazon's internet-based platform would allow it to expand in all sorts of different areas, eventually become the dominant way for consumers to shop, they were right. They had to wait a very long time to see that come to fruition, and they could have bought it cheaper anytime over the next 10 years. Similar story for Microsoft. You'd be at about $100,000 if you bought at the peak in 99 there. You don't break even until 2015 for Microsoft. If you invested in Pets.com or Lucent Technology or Global Crossing, you lost all your money. So all that's to say, transformative technology can be lucrative for the people that get it right. It's very hard to predict the timing of that. It's very hard to predict who the winners and losers are going to be. And it's hard to predict exactly how much money is going to be made by the companies involved in this. And so right now, investors are betting that AI is going to be fairly successful. It's betting on those top 8 companies to be winners. And that's what we're seeing in the returns in 2025 so far. Now let's shift to the other 492 companies. Those are still up about 12% for this year. So that's still really strong. And again, in the face of higher interest rates, tariffs, things like that. And that's maybe more unexpected. But I think investors are looking through the lens of AI with these companies as well, not in terms of are they going to make tons and tons of money by selling the products, but how are companies going to get more efficient by using it? So companies that use AI will likely have lower labor costs. They'll be more productive, more efficient. They'll make better decisions over time. So that's part of the reason stocks have been strong in that area. Also, earnings have been relatively strong. Even though tariffs have been a headwind, a lot of companies have still made decent money over 2025. We have unemployment starting to tick up, but it's still relatively low relative to history. So there are ways you can kind of look through the weakening economy to say, yeah, companies are still in overall pretty good shape, and we're willing to invest. You also have the Fed starting to cut rates, which is helpful for risk assets as well.
There's a lot of unknowns about AI. I mean, AI has been around, it's on our smartphones, our computers, that kind of thing, but there's still a lot that's not known about AI. Have you ever seen, or can you compare it to something in the past where investors have it seems like they've jumped in on it head first, right? Is there something similar in the past to what we're seeing with AI today?
Well, so yes, certainly the internet, right? In the late 90s, we didn't know how companies were going to monetize that. Amazon didn't break even for a long time, right? Like they were losing money for a very long time before they started to make a ton of money. They didn't understand a lot of the potential. Things like YouTube didn't exist for a long time after, right? So people were very much taking a leap there. Now, you did see malinvestment happening over that time period because, again, people didn't know what was going to come. They made a lot of bad investments. They made a couple of really good investments as well. And I think there is a parallel between those two items. I think another reason stocks are strong, not just AI or those sorts of things, is that the economy has shown a lot of resilience since 2009. There hasn't been a quote unquote real recession or a prolonged market sell-off since then. And I'm taking out 2020 because that was kind of an exogenous shock, which governments pumped a bunch of money into, right? And the market recovered quickly. It wasn't a business-led recession. So if you're an investor and people were talking about recession over the last 16 years, and you said, no, that's not going to happen. I'm just going to invest in the stock market anyway. You were rewarded for that, right? If you bought the market after a 20% dip, you were rewarded and relatively quickly. So I think with the fact that we haven't seen that sort of real economic-led market shock in the last 16 years, you may see some complacency in the market right now, right? Like investors are willing to discount that and say, the equity market's been pretty safe for the last 16 years. It's probably going to be safe going forward. That may be true. And it could be 20 years before we see another recession, right? That can happen. I think, though, when you see that economic downturn come through, it could get really ugly because you have not had the situation where investors invest, the market's down 20%, they buy in and they get hit another 20%, right? It happened in 2000. Market was down like 45% from the peak. 2009, it was down 55% from the peak or more. So when you have those pervasive market sell-offs, like things can rattle investors pretty quickly. So that's something else to watch out for.
So you mentioned interest rate cuts. Last month, the Federal Reserve made its first interest rate cut since the second half of 2024. What impact will this latest cut have? And do you anticipate any more cuts this year?
Yeah, in general, when the Fed cuts interest rates in like the kind of precautionary way they're doing right now, it's generally viewed as being supportive of risk assets. So things like equities, high yield bonds, real estate, people tend to think more highly of them when the Fed's cutting rates like this. In terms of whether we're going to see more, I think the Fed has a really tough job right now. So as many people are aware, the Fed has a dual mandate. The first part of that mandate is stable prices. The Fed defines that as an inflation rate around 2%. The other mandate for them is to maximize employment given price stability. So as long as inflation's around 2%, how high can you get employment? That's how the Fed looks at things. Right now, inflation's running around 3%, and that's lower than it's been in recent years, but it's still above the Fed's target. And at the same time, we're starting to see things like job creation erode a little bit. Subprime auto delinquencies are starting to tick up a little bit. So the Fed wants to get ahead of this. But it also has to be careful because if you cut rates and inflation's too high, you can exacerbate inflation, which they really don't want to do. This is all made more difficult with the introduction of tariffs because tariffs present a shock that's kind of a one-time raise in prices, and it may or may not be inflationary long-term. I think there's a debate about that right now in the markets. So you may be hiking inflation with those tariffs, and also you're probably putting pressure on the consumers with those tariffs as well, which is going to lead to a slower economy. So the Fed's, they're already in a tight spot, and now they have kind of less visibility in terms of what's going on because they don't know how the tariffs are going to affect things. So we do think the latest cut from the Fed is a signal that they think the balance of risk is more towards economic slowdown at this point. They're clearly saying, we'd rather be careful on the economy and risk inflation being a little bit higher because we think that's the right thing to do at this point. They have said that they're going to be data dependent going forward. The market is saying, no, the Fed's going to cut 2 more times. The probability is very high from the market that the Fed cuts in October and December at their next 2 meetings. If they do that, that would put the target rate at 3.5% by the end of the year.
Nick, since you're overseeing a multi-asset strategy, what economic indicators have you been watching closely through the first 3 quarters of the year? And which ones are you keeping an eye on as we go through the final quarter of 2025?
Yeah, I think throughout this whole period, it's really been the question of can the Fed walk the tightrope of ensuring that employment numbers remain strong and inflation stays under control, right? So for me, it's what's inflation doing? What are payrolls doing? How's job creation going? If everything kind of is okay on that front, risk assets should still remain strong. If you start to see weakness in the economy, the Fed's going to have a tough time cutting rates maybe without letting inflation get out of control, and vice versa. If inflation starts getting out of control, the Fed might have to hike rates in the midst of economic issues. So it's really, can the Fed walk the tightrope?
Nick, thanks for providing some insight into the economy and the markets. It's a great discussion today.
Thanks.
And thank you for joining us. The SWIB Market Update is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media, branded podcast production for businesses, podcampmedia.com, with editing by Matt Covarrubias. Thanks again for listening. I'm Chris Preisler.